presentation. We have three experts for your delectation. On my right is Laurence Seyer of AXA. On my left is Anne Richards of Aberdeen. And on my far left, though not necessarily politically, is David Blake of the Cass Pension Institute at the Cass Business School. And we're going to try and cover quite a wide range, but we're going to start with some opening remarks from each of the panellists on the big issues they think are happening in the pension industry. And we'll start with Laurent because he's been here throughout the session for his thoughts.
Thank you very much. First of all, I'd like to apologize for my weird French accent. I appreciate I'm the only non-British speaker here on the panel, so apologize for that. I wanted to practice my accent this morning by watching the local TV, but it was Sir Alex Ferguson on all channels. And so I'm afraid that I don't believe I would be easier to understand if I try to imitate his accent, so you apologize. Well, yes, I've been around for the couple of days, and I have to say I've been impressed. First of all, with the audience, the attendance, and the number of questions, challenges, topic, themes that were addressed. From my perspective, obviously, I'm not the best place to tell you what's going on in the UK market. My UK colleagues are much better placed than I am, but from my global perspective, dealing with pension schemes all over the world, and as part of AXA Group, I'm amazed because obviously the issues we have to deal with are all the same. I mean, we are all in the same business. Our societies are enjoying higher longevity, aging populations, and that's a chance. That's a blessing, obviously. We know that the government-sponsored schemes won't be enough to pay my pensions and my kids' pensions, and we have to navigate as fund managers and trustees in this low-rate environment, volatile markets environment. It's the same everywhere in all types of societies we live in. What amazes me is that the answers we give are so different from one jurisdiction, one country to the other. The regulations are different, and the schemes we've put in place are different. And again, coming from the other side of the channel, I have to confess I'm quite impressed with the maturity of the UK market to some extent, because I think that there are many issues where in France or in continental Europe, we are still at the phase where we are wondering whether we should do something about the issues we have to face. When in the UK you do face challenges, you do have to deal with the shift from DC to DB to DC. You do have to face the challenges of auto enrollment, but at least you're moving forward, and you have already started to do things. So and you are more in the phase to really discuss and debate about how you do it, and so. I think you should be proud of that, and I have to confess again that I was quite impressed with this throughout the 2 days. Sorry. Something also that really strikes me. It was not a specific theme of any of the sessions, but I think that it was a topic that was underlying to most of the discussions I've been participating to. Was the topic around transparency, education, communication. I think that's something that has definitely changed. It will never be like it was before. I think that we have all learned from the crisis as fund managers that probably we know that we don't know. We don't know what the market will do. In the coming years, we are not able to predict the markets. We are able to have views. We work hard to make sure that our views are as relevant as possible, but we have to confess that probably we are not sure, we cannot guarantee what the outcome will be. And therefore, in this new environment, what is for sure is that I believe that people will never ever accept, in a way or another, that we keep doing what we have to do without trying to make it clear to them, without trying to really explaining, being transparent about what we are doing as portfolio managers and as trustees. So I think it is very true in the relationship that we have, fund managers, with you guys, trustees, but also in the relationship you trustees have with your members. And this idea around education, transparency, communication, I believe was really something that I found was an underlying theme throughout all the couple of days. And that's probably one of my takeaway. I think as a company, we have to invest more in these fields. So that's my opening remark.
Thank you very much. Anne, what do you see as the big issues?
Well, I think I'll start by apologising for my funny accent as well, and I hope you can understand me, but since you've all been listening to Alex Ferguson this morning, and I come from a not entirely dissimilar part of the world, perhaps you've been well broken into that. The biggest challenge facing pension schemes is around risk, and it's not around longevity risk or liability matching per se. Clearly there are big risks we manage it, that we have to manage and we have to think about. But it's almost at a stage before that. How do you deal with risk in a world where there is no risk-free rate anymore? We might have return-free risk, but we don't have risk-free returns. When you have central banks manipulating the yield curve to the extent that it manipulates both your liabilities and your assets potentially, and in a way that is counterproductive, when you are in a world of financial repression that is reducing the real return that savers can get. So in a world where many of us have grown up thinking about risk in terms of volatility, in terms of tracking error, in terms potentially of value at risk, actually none of those things really help you address many of the risks that we all saw emerge, particularly in 2008 in the crisis. The things like counterparty risk, the things like liquidity risk, political risk. We all lived through Cyprus and the fact that the government guarantee on depositors' deposits for a period of time over one rather nerve-wracking weekend seemed like it wasn't actually a very good guarantee, because at one stage they looked like even if you had that guarantee, they would still give you a haircut anyway. Regulatory risk, we all know about that, whether it's in the pensions world or Solvency II or various others. So I think there is a whole big challenge for us as an industry to get better at finding tools to allow us to think about risk in a way that has meaning to our members, and that's true both for the DC world and the DB world. And actually I think that's the biggest challenge that we have.
Thank you. Professor Blake?
Right, well, I'd just like to raise 4 issues, some of which will impinge on what's been said so far. I think the first thing is design, getting the design right. At the moment, and auto-enrollment is an opportunity to do this, DC plans are not well designed. There's no integration between the accumulation stage and the decumulation stage. And I use the analogy of a commercial airline flight. If you want to go from London to Sydney, you know you need the right kind of aircraft with the right amount of fuel. And there is a good chance that with that you'll end up in Sydney. With the absence of defined benefit schemes, a good DC scheme can't guarantee that you can get to Sydney. But an adequate DC scheme might say, well, I can get you to Melbourne, and Melbourne would be success. But if it comes down in the middle of the Indian Ocean, then I don't regard that as a successful aircraft flight. If you then look at pension plans, there is no sense of design. The accumulation phase has got no connection with the decumulation phase. If you were designing this properly, you'd look at what's the desired output, what standard of living would I like in retirement, when do I want to retire, what is the fund size that I would need on the retirement date to deliver that pension in retirement, that standard of living in retirement, and then what is the level of contributions? It's the adequacy of contributions that is one of the most important things. Where's this 8%? The auto-enrollment 8%, completely inadequate pension in retirement from 8%. However efficient the fund managers are, however good the investment strategy is completely inadequate. So the combination of adequate contributions and the investment strategy is going to be something that we really ought to. Defined contribution is the last game in town. The state pension is going down, defined benefit is going down, it's the last game in town. We must get that design issue right. And the second point would then be about the investment strategy as well. Everyone's talking about new balance management, diversified growth, target date funds. No evidence to support the fact that, or the case that these are good investment strategies. Where's the evidence? Where's the stochastic modelling that we see to show you that these are going to give you reasonable outcomes in retirement? There isn't any. And then the issue of active fund management. I've spent a lot of the last 30 years looking at the performance of fund managers, both in mutual fund space, in pension fund space, and there is no evidence whatsoever that 90% of active fund managers can beat the market. No evidence that 95, 97, 98% of fund managers can add value over the fees that they charge, over the active fund management fees. But they don't want to hear that story. They don't actually read the academic literature. The other thing about this country is the fund management industry, the pensions industry in this country is intellectually retarded. It does not read the academic research. If you go to other countries, they do read the academic research. They take it into account. It's a feature of the design of their products, but not in this country. And then finally, charges. The other thing that we know is critical is charges. And I know we had the debate earlier on today. Well, we can have value for money. If you have high charges, you can have value for money for high charges. No evidence for this whatsoever from the academic literature. So these are the things that I'm going to make sure that you hear, and I will, not only in this room, but when auto enrolment in the country, whenever I'm offered an opportunity to quote in the press, this is what I'm going to be telling you.
Good, well, it's fighting words now. I like the idea. I like the idea of DC plans as sort of Ryanair with lots of extra charges, and you're not sure where you're going to end up, like 400 miles from Frankfurt to go there. Could I just follow up on the DC thing? You say you don't think much of I've just studied the US pension market a bit, and I'm surprised what you say about the academic literature, because I've just written something about the US public pension funds, which seem to ignore all the actuarial work over here and still obsessed with discounting their liabilities by an 8% rate of return, which they're never going to achieve. And you can talk to them that are blue in the face and they don't seem to recognise the problem. So I'm slightly baffled by that point. But they have moved in the DC space. They're ahead of us. They've got more DC assets than we have, and they have very much moved to a target date fund model. Now, do you think that you don't think that's a good idea by the sound of it?
No,
do you think we will go that way, regardless of whether or not?
No, I didn't say that any particular investment strategy was wrong. All I was saying was that we haven't seen the evidence for particular investment strategies being effective. We have not seen the evidence in stress market conditions that these are going to be effective. I'm not saying that any particular strategy, life cycle strategy, or target date funds, or New Balance, or whatever they're called, but it's often a reinvention of an old strategy with a new name. And that's what this industry also does.
Yes.
So no, I'd like to see the evidence. I'm not against any particular strategy. I just want to see the evidence of success and how they work in stress market conditions, which is what Anne was actually saying.
And just one other point on the DC. You mentioned 8% being inadequate, which does seem clearly right. But the reason, and we're not even getting to 8% initially anyway. We're starting very slowly. The trade-off there is it's a new tax on employers and employees. Is how many. So you're trading off this new auto-enrolment scheme against what many people resent as a tax. So you try and bring it in slowly. What would you regard as the ideal contribution rate to balance off this issue of taking money out of people's pockets now relative to them getting a decent pension later on? Well,
you have to say, you've got the 5,000 state pension as well to take into account. But if we didn't have the state pension, then we are talking about 15 or 16%. That's right. That's what we're talking about, and working until your high 60s. In order to get a decent pension.
But if you split that half and half, say, as the current scheme is to employ employees and the state rebate, that's sort of 7% contribution from employees, many of whom will be on minimum wage or similar. That's a huge cut to their standard of living right now. Do you think
Well,
people would still take part in it?
There is a case. Well, I mean, I think that if auto enrolment fails, if soft compulsion fails, then we have to look at the Australian model of hard compulsion, of mandatory contributions, because the risks we're passing on to the next generation of this generation not making enough pension provision are simply too great. But there is clearly a case for whether for low-income people, this auto enrolment thing could be some form of mis-selling. They might actually be better off had they relied on state and means-tested benefits and so on. And clearly, there are going to be cases where we will show cases where people would have been better off not doing this at all. But there clearly comes a point where, above that, people must save for their own retirement. Most people in this country must pay for their own pension. They can't rely on other people. A small number of people who have low incomes for all their lives can rely on the state. But most people can't rely on the next generation. They must save for their own pension.
Now, Anne, fantastic restraint in avoiding giving David the hairdryer treatment there during his drive out against active fund managers. Absolutely. But just on the DC, on the Nest and the auto enrolment, is that an attractive business for Aberdeen? Is that, with the low charges built into it, is that something you're interested in?
Well, I think so much depends on how things are structured in a way to get critical mass, because there is no doubt that there is a fixed cost of provision for any individual, and there is a certain cost, and if contributions are very, very small, it becomes very, very difficult to scale that up. Plus, I think, as David was alluding to, if you're at the lower income end as well, you have the issue that the incremental capital loss is of a higher risk to you as an individual than it is if you're further up the scale, which does suggest that there needs to be greater demarcation and modelling between that. So I think there are some quite interesting ideas out there about how you can give people the security to encourage them to save in the early years by some level of underpinning of capital values, and to think of clever ways of doing that, which then allows confidence to build. So you're potentially giving up investing in more growth assets in the earlier phase, but to build that confidence and to build a scale of pot which then gives greater confidence, at least in the middle years, of taking more capital loss, the possibility of taking more capital loss. It is actually linked in a way, though, to what I said in the introduction, because some really interesting points around the whole issue of how you think and measure about risk, because ex ante and ex post, to get a bit technical about it, can give you a very different perspective on things. And I think one of the challenges that there exists in a lot of the academic literature, which is looking at different variants of short-term volatility, be it tracking errors or being other things, short-term volatility is not a good proxy of many of the types of risks that actually have hurt individuals. And I think when you come back to scheme design, capital loss, permanent capital loss, is the real risk that people, particularly over the lifespan of a pension, have to think about. And how we find ways of separating and distinguishing between the worry that is caused by short-term volatility, which actually, in a way, you want to park, and the really severe risk that you have permanent impairment of capital. That's the challenge, and I think that's the thing that we've not really.
Do you want to revive with profits policy?
Do you know, there were many things wrong with profits, but I think that an element of pooling and sharing and smoothing of risk actually gets us over some of the challenges that we have today. So without saying that they're the answer to everything, absolutely not, but there were some elements which actually have some attractions, yes, I would say that.
Laura, you're involved in the DC business. How do you see this?
Yeah, I'll make a quick comment just to confirm I fully concur with Anne that it's extremely important, I believe, that we give people confidence that they keep saving even in times when their asset values fall. That's so, I don't know exactly how you do it, but clearly that's a key objective in my view. I'd like to rebound on, if I may, on David's comment around the academic world. I think that there are examples where the asset management industry has taken benefit and advantage and has been really close to the academic world. And I found your assessment a bit tough. I have in mind, for example, all the smart beta developments recently, especially in the UK market. I mean, you mentioned passive management. As far as I'm concerned, and even as a consumer of funds, I don't think, and I'm not looking for an evidence that a solution is the solution that will fit everyone. I think that more and more what we see, especially in the relationship with schemes, is that we tend to design more and more bespoke, individualized solutions. And maybe at some point, and if we look at the US market, we will even have to go to the individual level when we will have to fine-tune the schemes. But I think that really the passive management business has evolved in a clever way, in my sense, and I think that the academic world clearly was at the beginning of the thoughts and the thought leadership around the weaknesses of cap-weighted indices, and that's a good example. So I found you a lot of energy in your assessment, but to some extent I'm more optimistic in the fact that we as a community can work in an efficient manner with the academic world.
No, I was saying that this is not universal. I mean, the academic research is taken much more seriously in some countries than others. You know, it's taken very seriously in Holland, for example, much more seriously than it is over here. So it's not that it's ignored, and certain strategies are actually built off the academic research, but you need all the analysis and modelling and rigour of that, and we don't see that over here. In my view, we just don't see.
Let's move on to asset allocation, and I suppose the big issue for many people here is equity markets are doing well this year, but bond yields are falling, so assets are going up, but liabilities are going up as well. There was much talk at the start of the year of a great rotation out of bonds and into equities. Doesn't seem to have happened from the flow of figures, but should it be happening? Should people be taking more risk in their portfolios now that you were talking about government bonds as offering return-free risk? Or should they be using the opportunity of higher equity prices, if it has reduced their deficits, to try and de-risk and lock in the gains they've already made? What do you think, Anne?
You know, it's the big call that all of us on our side of the fence, on your side of the fence, on every side of the fence are looking at, wanting to get right. Is when do you sell your bonds and buy equities? What is everybody can see the potential for a bubble in bond yields, whether it's in the UK, whether it's in the US, and the challenge that all of us have is that we don't really know if the central banks stopped fiddling with the yield curve, where would yields naturally settle? But essentially, what central banks have been trying to do around the world has been to bring inflation back into the system, because central banks know how to fight inflation. Deflation is much, much harder to fight. So you have this as the conundrum. So I think everybody can see that there is a real risk that 10-year bonds plus are overvalued. What the challenge is in what time frame will that overvaluation correct? And it could carry on. They could carry on being overvalued as they have for some time, really for a considerable amount of time. So that's the challenge. I think one of the reasons that you've seen the rally in equity markets, though, is more to do with this idea of where your counterparty risk is. Because I come back to what I said about Cyprus and the cash. I think a lot of people have got very, very concerned about the strength of the covenant that they have when they own bonds of different flavours. And actually, although equities give you more short-term volatility, valuations don't look excessive. They don't look very cheap, to be honest. They're kind of ish on their long-run averages, a bit above maybe whatever, for whatever that's worth. But at least you know if you are buying your share of Unilever or Nestle or BP or whoever it might be, you have a concept of the real asset that underpins that you are buying. And I think that has driven as much the flows into equities. And I tend to see that although there will be ups and downs, that is likely to continue to be a trend for some time.
So Carmen Reinhardt of the Rogoff Reinhardt, she was giving an interview the other day which said basically she said pension funds are screwed because she has this concept of financial repression, which is holding interest rates below the rate of inflation. And that enables governments to work off their debts, but it means pension funds invested in bonds lose money over the long run. Because to me, the fascinating point is governments have lots of money in public sector pension funds, and so they're screwing themselves, which of course politicians are probably quite good at. But Lauren, how do you see this issue of what are you saying to clients about whether they should be taking more risk at this moment or less risk?
Sure. So firstly, I'd like to, I fully concur that we haven't seen this great rotation trade, and I think we haven't seen it because it just can't happen right now. It can't happen because, of course, bonds are expensive, but institutional investors, they just can't sell bonds because they've got liabilities and they've got a regulation that in most cases forces them to hold bonds. So it just can't happen. So it is true that we have seen tactical rotation that obviously investors have tried to take advantage of the fall in risk premiums. That has happened, but to us it's really only a tactical trade rotation rather than a shift in the strategic asset allocation. So that's very clear. It has happened, but not from the long-term institutional investors. If you look at hedge fund managers, their net long position in S&P 500 is probably very close to historical highs. So that's where the trade comes from. It doesn't come from where we very often believe or where it should come from. So that's the first point. But the reality is because it does not happen because it can't happen. Not only because, again, of the regulation, but also because the central banks have been flooding the bonds market with cash. And so something very interesting with government bonds is that these vehicles, they are not held by individuals. I mean, you and I, we don't buy bonds. And so and we have seen figures in one of the sessions. This market is very weird. So yes, I mean they are very expensive, but the rotation does not happen for the reasons I mentioned. Now, should investors diversify, and is there more appetite for risky assets? Yes, and I think it's beyond equity. I think we are going to touch base on other asset classes, but yes, obviously. And it's no mystery and no very innovative assessment here, but with the level of interest rates and with the risk that actually in Europe we are stuck in a Japanese-like deflation scenario for some years, obviously there's no way. We have to diversify away from government bonds.
David, would you take the financial economist view that pensions are a debt-like liability? The business of companies is to make widgets or sell cars, whatever it is. It's not to speculate on their balance sheets by buying equities to meet that debt, or would you take a different view?
Yeah, I as you say, this is, as answered, this is a risk management business. Defined benefit is a risk management business, and the risks with defined benefit are not having an asset allocation that matches your liabilities. That's the risk. The risk is not matching the liabilities. And since the liabilities are bond-like, or index-linked bond-like, you should be matching those liabilities with index-linked bonds or the nearest equivalent to those. If you don't do that, you're taking risk with respect to your liabilities. No other two ways about it. You might be a smart fund manager and get the equity risk premium on top of that as well. But the other point I want to make, just to follow on from the previous two speakers who talked about market timing, the academic evidence from every country in the world shows that fund managers are no good at timing markets. They have no idea when it's the right time to sell equities and buy bonds, to sell Europe and buy the Far East. No evidence whatsoever that fund managers can time markets. The good fund managers, the only source of skill of active fund management is a small number of them, having done a lot of research, can pick some value stocks. They can pick some good stocks that will outperform the Warren Buffetts of this world. Only a very small number of them do that. But then they charge a fee large enough to take all the value added for themselves, so the investor ends up getting nothing.
I'm amazed fight hasn't broken out yet. Of course, by definition, all fund managers can't be good at timing the market, because then the market would never reach a peak from which it would go down, right? Because they'd all have sold before it got there.
Whatever it is, they all make losses from market timing.
Well, let's look at some of the other sources of risk-free return that Lauren suggested. because everybody in here has probably been around the equity circuit a couple of times, and were very heavily invested in equities in the late 90s, and then have had two awful bear markets in the last 30 years. So people are talking about other sources of return. So infrastructure. What's your view, Anne, on infrastructure? I think I've been to at least 5 infrastructure conferences in the last 18 months. Is that the big hope?
It's you know, like bridges are sexy, right? They've become really sexy because they produce this stuff called income, which is quite difficult to find in other places, and actually you get a real thing that you can touch, which is actually quite comforting. I think, you know, I'm banging on a little bit here about the same thing, but when you look back and you know, whether you're looking at the DB world, whether you're looking, as I'm tending to talk more broadly than just looking at your specific liabilities on a specific scheme, but whether you're looking at what you're trying to do across the lifespan of a DC or even a broader savings environment, actually what you need to do is you need to consider in this very uncertain, every world is always uncertain at any moment in time, but it does seem that we have a particular set of uncertainties just now. You have to consider a range of different scenarios, many of which are quite opposing and which can be made with equally valid conviction. They may be very clear after the fact, but ex ante, as I said, they may not be at all clear. And when you look at a portfolio of assets in that way, and thinking of a number of different scenarios and how it might be expected to perform in those scenarios, real assets like infrastructure definitely have a part to play, because they give you, at the right price, and much comes down to price, but at the right price, they give you something which will behave differently to some of the other bits of your portfolio. And I think that is why having some element of real asset in there, particularly if you can get an inflation-linked element to at least part of the income stream, is a really interesting thing to consider.
Lauren, do you agree? You like infrastructure?
Very much so. I believe, well, that's a hot topic, as you mentioned, in Europe right now. Actually, it's been some years elsewhere that people have been looking at, institutional investors have been looking at infrastructure. I think it was back in 2008 when CalPERS for the first time made their new policy announcement. I think that they would target 8% in infrastructure. And as we know, in Australia and in Canada, there are some schemes that are invested up to 10% and beyond 10% in infrastructure. So that's something that is not new if you look at it from a global standpoint. I believe, obviously, infrastructure has some fixed income features that are very appealing to DC schemes. Clearly, they match the duration liability. So they are, in most cases, they are inflation immunized or inflation protected. And they have a low correlation with other asset classes. So all these features, I believe, makes infrastructure an interesting potential investment to look at. Obviously, risk, as Anne mentioned, is a big question. So the schemes need to make sure that they either have the capacity internally or they team up with people who are able to analyze the specific risks of this type of investment, and they are very specific. But I think there is a lot to do. I mean, the market is, we are talking about dozens of trillions of potential assets. So far, we have seen investments mainly on the equity side of the infrastructure business. I think we can also go to the debt side of the infrastructure market. So there's a lot to be done. Obviously, we will need some help from the regulators also on that one, because in many jurisdictions, the regulation is not very friendly to this type of investments. But I do believe that they are worth considering.
David, I don't know whether you're cynical about this one. I'm confess on a couple of points I worry. First of all, I don't know how many people are from Birmingham here, but I've driven on that M6 toll road, which is an infrastructure investment. It's fantastic. There's nobody on it. You can do 95 miles an hour, but I don't think it's making any money for anybody because nobody wants to pay the toll. So that makes me cynical about it as an investment possibility. And the second thing, the government's very keen to encourage this, and we might have had Alan Rubenstein here, because it wants pension funds to invest in new infrastructure projects to save it money on, the public spending bill. But any pension fund you talk to doesn't want to do greenfield projects. It wants to do things that are up and running and pay a nice, safe 6 or 7%. So do you think that sort of circle can be squared?
I think that is interesting. By the way, this is when where I will agree with my other colleagues, that infrastructure with its index-linked cash flows is clearly, and long-term cash flows, is clearly a very useful asset to generate in pension plan design. But I'd like to answer your question by giving you some thoughts about some advice I've been giving to the World Bank, which is setting up a DC pension plan in a developed country. Now this country's got no equity market, it only has bank deposits, and it's got government bonds. And 60% of the funds have to go into the domestic market. If it went into the banks, this is going to rapidly destabilise the banking system, because that money is simply going to go into real estate speculation. Here is a case where infrastructure, this country needs infrastructure, so this is a case where investing in the infrastructure would provide a virtuous circle, because the whole point about funded pension plans is it helps to increase the capital stock of a country, increases productivity, increases wages, increases pension savings, and you get the virtuous circle. But if you've got no capital base to begin with, you've got to be very careful with the developments there. So here, infrastructure is clearly a very, very sensible asset for a new country with no existing capital stock. But there are the problems, as you say. They don't want the greenfield investment risk, and established countries like the UK, pension plans are not going to do this. But I don't think there is going to be much alternative into emerging market countries. They will have to take those risks. But I think that's a better risk-taking position than putting money into banks which currently have a 2% real return in these banks. But those 2% real returns will not be there for a long time, and I think you could end up with a Cypriot situation in which a lot of the money is lost. So it may be unavoidable in certain countries to do both the greenfield and then get the benefit long term.
Yeah. Well, you mentioned emerging markets, and let's come to that before I open it up to the floor. The last 18 months or so, emerging markets have been a bit disappointing, haven't they? But still, China, when it has a bad year, is growing at 7.5%, India 5 or 6%, compared with our measly growth rates over here, or virtually no growth, of course. Why do you think, Anne, that emerging markets have been so poor?
Well, it's interesting because we have a very large emerging market business where we struggle to sort of keep the money from coming in, and we have a pan-European team who are very keen to point out the fact that their European equity returns have beaten the emerging market returns over the last 5 years or so. So it is an interesting conundrum. Emerging markets, I think, are one of the most classic areas where it's important to remember that what you are doing as an investor, and I think this sometimes gets lost in the wash, because what you're doing as an investor is allocating capital. And the problem with some emerging markets, you mentioned China. China is a classic case in point. China has some tremendous opportunities within its economy, but as a minority shareholder, which is essentially all you can be, it is almost impossible to extract that. The value which you think might accrue to you from the growing economy there gets extracted away through poor shareholder rights and through various other things. And that's replicated in a number of other emerging market countries as well. So the challenge as an investor in emerging markets, and this is one area where I think just allocating to the beta is not a smart thing to do, is about genuinely thinking that what you are doing is giving capital to businesses and investing in those businesses, and thinking of yourself really as an investor and not as a trader. And I think that is where you can do well in emerging markets, because you get access to the businesses that are themselves growing because they are feeding into an emerging middle class, but that you as a minority shareholder alongside those businesses can actually get some of that value extracted. Which means that actually India has been a more attractive place than China to do business for quite a while, but is now actually beginning to become less attractive for all sorts of reasons of political interference. That's the trick with emerging markets.
Lauren, are you enthusiastic about emerging markets?
Yes, I mean, though I have to confess at the start that what happened, the performance of emerging market over the last 6 months, and especially Q1, I really fight and I struggle to understand, what happened. And I think from an investment research standpoint, I will be very interested in the coming months that people really look deep inside and try to understand. Because in fairness, emerging markets should have outperformed the markets by 10% over the last months. I mean, we are in a risk-on phase. There's lots of liquidity injected by the system in the environment. They should have outperformed, and so it's hard to understand. So I don't know what are the reasons why it did not happen. Maybe it has to do with their correlation to the commodity prices, which obviously had a negative impact. Maybe it has to do because some of the cash that should have gone to emerging market there has made a stop in the Tokyo Stock Exchange. For the reasons we know, but apart from that, I'm not quite sure. So, as an investment professional, that's very interesting because I have to confess, I mean, it should have outperformed, and it did not. Still, I believe that the sentiment amongst investors towards emerging market is improving. And we do believe that it's definitely an area to look at. We have outweighted recently, for example, our emerging market local debt allocation. That's something we like. I've looked at some trades in Russian government bonds, for example. I think it's a pretty liquid market with a steep curve, good carry. So they are definitely good investments to be made.
Oh, good. Well, I think Socrates